Imagine a quiet Tuesday morning in your neighborhood. The lawnmowers are humming and the commute is normal. On the surface, nothing has changed. But beneath the pavement, an invisible thread is being pulled, one that stretches 6,000 miles across the Pacific to a wood-paneled room in Tokyo. For over a decade, the global financial system functioned on a singular high-stakes bet known as the yen carry trade. As of late 2024, analysts estimate that trillions of dollars were borrowed in Japanese yen at near zero interest rates and recycled into high-yielding American assets. Everything from Silicon Valley tech stocks to the massive debt packages used to build suburban shopping centers and luxury apartments. But in mid to late 2024, the Bank of Japan did the unthinkable. They began raising interest rates. This wasn't just a policy tweak, it was a tectonic shift. When the yen strengthens, that cheap money becomes incredibly expensive to repay. To cover their positions, massive institutional funds are forced into a liquidity vortex, selling off their most stable U.S. assets to pay back Japanese lenders. This is where the thread leads to your front door. Think of the for sale sign 3 houses down that's been sitting for months, or the local office park facing a sudden foreclosure. These aren't isolated incidents of local mismanagement. They are the collateral damage of a global margin call. Industry reports indicate that as the yield spread between Japanese and U.S. bonds narrows, the capital that once flooded the U.S. housing market is evaporating. We are currently tracking a $1.5 trillion commercial real estate maturity wall set to hit by the end of 2025. As these loans come due in a world where cheap Japanese credit has vanished, the shockwaves won't stay on Wall Street. They flow directly into your home equity. Your property value isn't just a reflection of your school district. It is the final link in a global chain that is currently under immense tension. When Tokyo sneezes, your neighborhood catches the flu, and the fever is just beginning to rise. To understand why the math of the American housing market is breaking, we have to look at the systemic liquidity vortex. For 40 years, American wealth was built on a simple equation. The appreciation of the asset outpaced the cost of the debt used to buy it. But as we move into 2025, that equation has inverted. This vortex operates in 4 distinct stages, and according to many market observers, we are currently entering the eye of the storm. Stage 1 is the inversion of the spread. In late 2024, the gap between what a property earns, its yield, and the cost to finance it narrowed to its thinnest margin in decades. When the Bank of Japan adjusted its interest rate policy, it didn't just affect Tokyo, it spiked the global cost of carry. For institutional investors, the cheap money used to fuel massive real estate portfolios suddenly became a high-interest liability. When the interest on the debt exceeds the rent from the tenant, the asset transforms from a wealth builder into a wealth destroyer. This leads to stage 2, the maturity wall. According to data from industry analysts at TREP and MSCI Real Assets, approximately $1.5 trillion in commercial real estate debt is set to mature by the end of 2025. These loans were often inked during the record low rate environment of 2020 and 2021. As they come due, owners are finding that they cannot refinance at 3% or 4%. They are facing 7% or 8% rates on buildings that have, in many cases, lost 20% to 30% of their appraised value. This isn't just a corporate problem. Regional banks, which hold a significant portion of this debt, are seeing their reserves under immense pressure, limiting their ability to issue the residential mortgages that keep the housing market moving. Stage 3 is forced deleveraging. To protect their balance sheets, institutions cannot simply wait for market recovery. They are forced into what market observers call involuntary selling. We're beginning to see the early markers of this as of the second half of 2024. High-quality performing assets are being liquidated at a discount just to raise the cash necessary to cover debt service on failing properties. This creates a feedback loop where selling begets more selling, further depressing market prices across the board. The final stage is the valuation vacuum. And when liquidity evaporates, price discovery fails. In a normal market, your home's value is based on what the person down the street paid. In a liquidity vortex, that baseline disappears. Historical parallels to Japan's lost decade suggest that when the credit spigot turns off, the traditional math of the market no longer functions. The value of your home is no longer determined by your local school district or your kitchen renovation. It is dictated by the desperate need for cash in a global system that has run dry. The math has stopped working. And the vortex is now pulling at the very foundation of the American dream. To understand the true magnitude of the liquidity vortex currently swirling around the 2025 housing market, we have to step out of the present moment and look at the ghosts of the past. Economists often speak of black swan events, unpredictable anomalies that catch the world off guard. But for those who study the long-form cycles of credit and debt, the cracks appearing in late 2024 are anything but unpredictable. They are the rhythmic echoes of 1926, 1986, and most critically, the 1990 Japanese asset bubble. History suggests that every great real estate collapse is preceded by a period of extraordinary popular delusions, where the cost of borrowing becomes detached from the reality of the asset's value. When that detachment reaches a breaking point, the correction isn't a slow leak, it is a violent decompression. We begin our journey in the mid-1920s. Before the Great Depression reshaped the world, there was the Florida land boom. By 1925, the narrative was that Florida was the last frontier of American prosperity. Much like the post-pandemic surge in the Sun Belt, capital flooded into the state. Speculators were buying binder boys contracts, the 1920s version of a high-leverage derivative, flipping properties they had never seen with money they didn't actually have. While many history books point to the Great Miami Hurricane of 1926 as the cause of the collapse, market historians note that the credit cycle had already peaked. The hurricane was merely the needle that popped a balloon inflated by years of unsustainable leverage. As of late 1926 data, property values had begun to plummet months before the storm hit because the supply of new, easy money had dried up. This mirrors the current situation in late 2024. While many are waiting for a specific event to trigger a housing correction, the underlying credit mechanisms, the very fuel of the market, are already being withdrawn by global central banks. The second ghost haunts the mid-1980s. This period provides a chillingly accurate parallel to the modern shadow banking crisis. In 1986, the American real estate market was hit by a dual-sided shock. First, the Tax Reform Act of 1986 arrived, stripping away the lucrative tax shelters that had incentivized massive investments in commercial and residential development. Almost overnight, the math of real estate changed. Assets that were profitable because of tax loopholes suddenly became liabilities. Simultaneously, the collapse of oil prices devastated the oil patch states like Texas and Oklahoma. Real estate values didn't just dip, they evaporated. According to historical data from the FDIC, this period led to the savings and loan crisis, where over 1,000 financial institutions failed because they were overleveraged in speculative real estate. Today, analysts are watching a similar regulatory shift. As of Q3 2024, the Federal Reserve's Financial Stability Report highlights increased scrutiny on non-bank lenders and shadow banking entities. Just as the 1986 Tax Reform Act changed the rules of the game mid-play, the tightening of credit standards and the removal of the liquidity punch bowl in 2024 and 2025 are threatening to render the previous 5 years of real estate strategies obsolete. However, the most formidable ghost, the one that provides the direct DNA for our current liquidity vortex, is the 1990 Japanese asset bubble. To understand the $1.5 trillion maturity wall facing the U.S. today, we must understand what happened in Tokyo 35 years ago. By 1989, the Japanese real estate market was the most expensive in human history. At the peak, the land under the Imperial Palace in Tokyo was theoretically worth more than the entire state of California. This wasn't built on organic growth. It was built on a foundation of cheap yen and corporate cross-leveraging. When the Bank of Japan realized the bubble was unsustainable, they began a series of aggressive interest rate hikes starting in late 1989. The result was a systemic collapse that led to the lost decade. But it did something else. It birthed the yen carry trade. To survive the domestic collapse, Japanese financial institutions began lending out their currency at near zero rates to be invested elsewhere, primarily in the United States. For 30 years, this cheap Japanese capital acted as the global lubricant for debt. It fueled the growth of American suburbs, the construction of luxury high-rises, and the expansion of the commercial real estate market. As we move through late 2024, the ghost of 1990 has returned, but with a twist. The Bank of Japan is no longer the provider of cheap liquidity. They are now the ones raising rates to combat their own inflation. This is the carry trade unwinding in real time. When Japan raised rates in July 2024, it wasn't just a local policy change, it was a margin call on the world. The 1.5 trillion commercial real estate maturity wall, set to hit by the end of 2025, is the American version of the 1990 Japanese collapse. According to industry reports from TREP, a massive portion of this debt is held by regional banks that are already under pressure. During the Japanese lost decade, these were known as zombie banks, institutions that were technically insolvent but kept alive by government policy. Market observers are now asking if the U.S. regional banking sector is entering its own zombie phase. The parallel is striking. In 1990, Japanese property owners couldn't refinance their debt because the value of the buildings had dropped below the value of the loans. Today, U.S. commercial owners are facing the exact same trap. A building purchased in 2021 for $100 million may only be worth $70 million in today's Ombredes high-rate environment, yet the owner still owes $80 million on the loan that is coming due in 2025. In a world where the yen carry trade is no longer providing cheap bridge loans, these owners have no choice but to default or sell at a massive loss. This is why the liquidity vortex is so dangerous. It isn't just about one sector, it is a century of cycles converging at once. We have the speculative fever of 1926, the regulatory and shadow banking shocks of 1986, and the systemic deleveraging of 1990. As of late 2024, data indicates that the yield spread, the difference between the interest earned on an asset and the cost to borrow, is at its most precarious point since the 2008 Great Financial Crisis. When this spread goes negative, the ghosts of cycles past begin to manifest. Historical validation tells us that markets can stay irrational longer than most people can stay solvent, but they cannot outrun the math of a maturing debt wall. Institutional investors are not waiting for a 2025 headline to act. They are already repositioning. Projections for the Q1 2025 maturity cycle suggest a significant uptick in distressed asset sales. This isn't just a speculation, it is the logical conclusion of a system that has relied on 3 decades of cheap Japanese credit that is now being called home. The American housing market has long viewed itself as an island, protected by local demand and limited inventory. But the lessons of 1926, 1986, and 1990 teach us that no asset is an island when the global tide of liquidity goes out. The $1.5 trillion wall isn't just a number on a spreadsheet, it is the sum total of a global debt cycle that has reached its inevitable conclusion. As we look toward 2025, the question is no longer if the cycle will turn, but how many properties will be caught in the vortex when the final ghost of 1990 finally settles its accounts. To understand the true magnitude of the danger facing the 2025 housing market, we have to look past the headlines and into the cold, hard mathematics of the debt cycle. While most headlines focus on the price of single-family homes, the structural integrity of the entire financial system is currently being tested by a phenomenon known as the tools at maturity wall. This isn't a theoretical risk, it is a fixed schedule of financial reckonings that cannot be bargained with. As of late 2024, data from industry analysts at TREP and MSCI Real Assets indicates that approximately $1.5 trillion in commercial real estate debt is set to mature by the end of 2026. To put that into perspective, this is a volume of debt that was largely issued or refinanced between 2019 and 2021, a period defined by the lowest interest rates in human history. At that time, the math of a deal was simple. Borrow at 3%, buy an asset yielding 5%, and pocket the spread. But as we move into the 2025 cycle, that math has been violently inverted. The Federal Reserve, at our SQ3 2024 Financial Stability Report, highlights a sobering reality. Many of these properties have seen their underlying valuations crater by 20% to 40% due to the shift in remote work and the rising cost of capital. When these $1.5 trillion in loans hit the wall, the owners cannot simply roll the debt into a new loan. They are walking into a bank in a 7% or 8% interest rate environment with an asset that is worth significantly less than it was 3 years ago. This creates what analysts call the appraisal gap. If a building was worth $100 million in 2021 and is now worth $70 million, but the owner still owes $80 million, the bank cannot legally or practically refinance the position. The owner is forced to either bring tens of millions of dollars in fresh cash to the table, cash that most do not have, or hand the keys to the lender. This is where the systemic liquidity vortex begins to pull at the residential market. This $1.5 trillion maturity wall is not evenly distributed across the banking system. While the too-big-to-fail Wall Street giants have diversified their risk, the American regional banking sector is uniquely vulnerable. According to data compiled through the second half of 2024, regional and community banks hold nearly 70% of all commercial real estate loans. These are the same institutions that provide the lifeblood of the American residential mortgage market and small business credit lines. When these regional banks begin to see their balance sheets choked by zombie commercial assets, properties that are no longer generating enough rent to cover their new, higher interest payments, they are forced into a defensive crouch. To maintain their required capital ratios, they must stop lending. This is the credit contraction phase. We are already seeing the early markers of this as of late 2024 FDIC reports. A significant tightening of lending standards for residential mortgages and home equity lines of credit, HELOCs. The spillover into the residential sector is a direct result of this liquidity squeeze. If a regional bank is facing massive write-downs on a portfolio of suburban office parks or retail centers, it cannot afford to issue a 30-year mortgage to a family down the street. The maturity wall in the commercial sector effectively acts as a dam, cutting off the flow of credit to the housing market. Without the continuous flow of new mortgage debt, the inventory of buyers shrinks, and the valuation vacuum we discussed earlier begins to take hold. Furthermore, market observers are closely watching the connection between this maturity wall and the shadow banking sector. Non-bank lenders now account for a massive portion of the mortgage market. These entities rely on warehouse lines of credit from the very regional banks currently hitting the CRE wall. If the banks pull back, the shadow lenders lose their funding, and the entire apparatus of the modern American mortgage system begins to seize. The math of the crash is further complicated by the global carry trade unwinding. Historically, when U.S. markets faced a liquidity crunch, cheap capital from Japan would often act as a secondary safety net. However, following the Bank of Japan's rate hikes in mid to late 2024, that safety net has been pulled away. The cheap money that institutional investors use to bridge the gap between maturing loans and new financing is no longer available. For the first time in decades, U.S. real estate must stand on its own 2 feet without the crutch of global zero interest rate policy. Projections for the Q1 2025 maturity cycle suggest that we are moving out of the extend and pretend phase, where banks simply delayed the inevitable, and into the forced discovery phase. This is the point where the loss is finally acknowledged on the balance sheet. When that happens, the feedback loop between commercial insolvency and residential credit scarcity becomes a self-fulfilling prophecy. The $1.5 trillion maturity wall isn't just a corporate headache. It is the catalyst for a systemic repricing of risk. As these loans fail, the regional banks that underpin the American dream are forced to choose between their own survival and the continued funding of the housing market. Historical data from the 1990 collapse suggests that in this scenario, the bank always chooses itself. The result is a market where the math no longer allows for the high valuations of the previous era. As we look toward the 2026 window, the maturity wall stands as the ultimate arbiter of value, a $1.5 trillion reminder that in a credit-based economy, when the music stops, there are never enough chairs for everyone. To navigate the coming volatility, we must look at the specific quarterly markers that will signal the acceleration of the liquidity vortex. This isn't a single event. It is a series of dominoes falling in a predetermined sequence. The first domino isn't a headline, it's a balance sheet. As we move into the first quarter of 2025, the first major wave of the $1.5 trillion maturity wall hits. Industry reports from TREP indicate that over $150 billion in commercial loans are scheduled to reset in this window alone. Market participants should watch the Q4 2024 earnings reports of regional banks released in January. If there is a significant spike in provision for credit losses, it confirms that the extend and pretend era has officially ended. This is the moment when the appraisal gap becomes a matter of public record, forcing banks to acknowledge that their collateral is worth a fraction of the loan value. By mid-2025, the focus shifts to the global stage. Following the Bank of Japan's rate normalization trajectory established in late 2024, The yen carry trade will face its most significant stress test. Analysts suggest this is the period where institutional margin calls could trigger a liquidation of liquid assets, specifically real estate investment trusts, REITs, and mortgage-backed securities to cover debts in Tokyo. Historically, this type of forced selling creates a contagion effect where non-distressed assets are sold simply because they're the only things left with value. Entering the yen third quarter of 2025, the systemic contraction hits the American driveway. According to projections based on late 2024 credit tightening data, this is when the credit crunch begins to fully manifest in residential lending. The marker to watch here is the delinquency rate of home equity lines of credit, HELOCs. If these rates begin to climb toward 2008 level trajectories, it indicates that the shadow banking sector, which fuels the majority of non-bank mortgages, is no longer able to mask the consumer disguise as lack of liquidity. By the stem fourth quarter of 2025 and into early 2026, the liquidity vortex reaches its peak. This is the forced discovery phase. With regional banks' balance sheets clogged by defaulted commercial assets, the supply of residential mortgage credit is expected to reach its lowest point in the post-2008 era. Without a bridge of cheap capital, the inflated valuations of the post-pandemic era will likely face a final violent repricing. These quarterly markers serve as your roadmap. While the media may focus on soft landings, these specific indicators will reveal the transition from a slow-motion correction to a systemic deleveraging. Mainstream financial commentary has spent much of the last year championing the idea of a soft landing. The narrative is seductive. Thanks to the post-2008 Dodd-Frank regulations and record-high home equity, the American consumer is supposedly insulated from a systemic shock. However, as of late 2024 data, this fortress balance sheet argument begins to crumble under the weight of hidden leverage and the shifting reality of the shadow banking system. The first pillar of this illusion is the belief that Dodd-Frank fixed the banking system. While it is true that traditional too big to fail institutions are required to hold more capital, the risk hasn't disappeared, it has simply migrated. According to the IMF Global Financial Stability Report, more than half of all global financial assets now reside in the shadow banking system, non-bank lenders, private credit funds, and hedge funds that operate outside the strict oversight of traditional banking regulations. In the United States, non-bank lenders now originate approximately 2/3 of all residential mortgages. Unlike traditional banks, these entities do not have sticky deposit bases to fall back on. They rely on volatile warehouse lines of credit from the very regional banks currently being squeezed by the commercial maturity wall. If those lines are cut, the residential mortgage machine seizes up overnight. The second pillar of the soft landing myth is the estimated $30 trillion in home equity held by Americans. On paper, this is a massive buffer, but equity is only a safeguard if it remains untapped. Data from the Federal Reserve Bank of New York, late 2024 reports, suggests a troubling trend: the rise of the HELOC, home equity line of credit, as a survival tool. For many households, that equity cushion is being actively hollowed out to subsidize the rising cost of living. As of the second half of 2024, HELOC delinquency rates have begun to tick upward for the first time in the post-pandemic era. While these figures remain below 2008 peaks for now, analysts suggest the trajectory is what matters. When home values stop rising or begin to retrace, these lines of credit become underwater almost instantly, turning a perceived asset into a primary driver of consumer insolvency. Furthermore, the soft landing narrative ignores the structural reality of the appraisal gap. Mainstream economists often point to low residential delinquency rates as a sign of health, but historical data from the 1990 Japanese lost decade shows that delinquencies are a lagging indicator. By the time a homeowner defaults on a HELOC, the underlying systemic liquidity has already dried up. In reality, the system is arguably more interconnected and leveraged than it was in 2008. The leverage is simply harder to see because it is tucked away in private credit markets. Industry reports indicate that the hidden leverage within these non-bank entities could be the primary catalyst for the 2025-2026 contraction. The soft landing isn't a forecast. It ends a narrative designed to maintain confidence while institutional capital prepares for the liquidity vortex. When the shadow lenders lose their funding, the illusion of safety will evaporate, revealing a residential market far more fragile than the headlines suggest. Understanding the systemic risks is only half the battle. The other half is observing how institutional capital positions itself before the vortex fully forms. While this content is for educational purposes and does not constitute financial advice, history provides a checklist of 5 markers that market participants often use to navigate a deleveraging cycle. First, analysts often emphasize liquidity optionality. In a credit crunch, cash isn't just for spending, it's dry powder. Maintaining liquid reserves allows for participation when assets are eventually sold at forced discovery prices. Second, observe counterparty exposure. Experts often audit whether their capital resides in regional banks heavily exposed to the 1.5 trillion commercial maturity wall. Third, monitor the shadow banking connection. Understanding which non-bank lenders rely on volatile warehouse lines can signal which residential markets are most at risk of a sudden credit freeze. Fourth, watch the yield spread. As of late 2024 data, the correlation between the yen and U.S. Treasury yields remains a primary indicator of global liquidity. Finally, prioritize de-leveraging. Historically, the survivors of a lost decade are those who reduced variable rate debt before the credit window slammed shut. By focusing on these institutional markers, the narrative shifts from panic to preparation. But as the traditional pillars of real estate and banking begin to wobble, a critical question emerges. Where does the capital go when your safe havens of the past century no longer feel safe? There is one specific asset class, often misunderstood and highly controversial, that is currently seeing a quiet influx of institutional escape capital. And its performance in early 2025 may shock the legacy system.